Bullion prices tumbled about 88 bucks an ounce yesterday amid ongoing concerns about a recession or deep recession in Europe. My next guest thinks, though, that it's a simple correction and says that now is the time to pick up gold company stocks if you're investing long term. Joining us from London to talk about the sector is Ian Williams, Chairman and CEO of Charteris Treasury Portfolio Managers. Ian, thank you very much for joining us this morning. Let's talk, first of all, your thoughts on the decline that we've seen in bullion. It wasn't just yesterday, though that was one of the sharpest declines in a long time. It has been declining for several weeks here. What's behind it in terms of your own view?
Well, if you go back to just before August, it was roughly around $1,500 an ounce, and it suddenly moved up very sharply to $1,900 without any real warning, and it was a very sharp and very definitive move. And it looked at the time, and the gold shares didn't really go with it either, and it looked at the time as if it was a bit of a climatic element to it, and that 1900 was probably trading a little bit above its equilibrium value. And I think what you've seen over the last few weeks is an unwinding of that froth that was built into the price, and now it's back down to the more realistic levels in line with the more supply-demand fundamentals. So it's probably a lot more soundly based now. The froth's been taken out of the market, and it's probably more soundly based than it was when it was at 1900, when it was probably way overbought technically.
We have a chart here that compares the price of bullion, the performance this year, with the XAU, the Philadelphia Gold Index. The stocks, it's been a tough go for stock investors, gold stock investors this year. The big names have underperformed. I know you've outperformed. How have you been able to do that?
Really just by stock selection, really, picking slightly better stocks rather than the slightly worse ones. But in general, the entire gold share market has underperformed bullion and not performed in line with anything like where it should be. I mean, most of these companies have production costs of around $500, $600 an ounce. They're selling gold at $1,500, $1,600, $1,700 an ounce. So they've got levels of profitability that most other sectors, apart from maybe the tech sector, would just dream about. And yet the shares are selling on price to book of 8 times earnings, single-digit PE ratios. The shares are the cheapest they've ever been in history. So there's a bit of a disconnect here with how well the companies are doing and how badly the shares are languishing. As Keynes once famously remarked, the markets can remain illogical longer than you can remain solvent. And I think there's an element that these asset class is just out of favour, and it's going to be some time, I would guess, before they come back into favour. But when they do come back into favour, there's a significant re-rating is going to take place with these shares.
Let's talk about some of the individual names, including Agnico Eagle, which has been a disappointment. We've had Sean Boyd on numerous times. It's been a difficult year for the company. It just seems every time you turn around, something is going wrong. How do you feel about this one?
Well, you know, the share price has obviously come back a long way after the Goldex mine was flooded, and they've had one or two other mishaps as well along the way. And they just seem to be hitting a run of bad luck at the moment. Everything they seem to touch, seems to misfire on them. Having said that, it's still a good company, and the share price down at the levels it is probably good value. I mean, with this Goldex mine, they've written it down to nothing in the books now, but that doesn't mean that it's worth nothing, because the geologists in the new year are going to try and find a way if they can mine the gold out using another entry point. So it's possible they may salvage something from this. If they do start to salvage something, you could see the shares perform quite well, as the shares have come back so much that there's some bounce back in them if they do start to get that mine underway.
And another one of the big cap names that people have focused on this year is Barrick Gold. The acquisition of copper assets got some investors a little bit disjointed in terms of their view of the company. What are you thinking about Barrick?
Well, we hold Barrick in the fund, but it's not one of our bigger holdings. I mean, we tend with the fund, although we own Goldcore is one of our biggest holdings, we tend to try and avoid the big 3 or 4 mining companies, because we think there's more growth potential in the medium-sized ones rather than the very big ones.
And so, but when you think about big versus small, what about the volatility associated with that, especially in the kind of environment we're in?
Oh, sure, but I mean, Agnico Eagle is a big mining stock, and there's not been many more volatile than that over the last 3-4 months. When we say medium-sized ones, we don't mean the juniors. We mean rather than have a big weighting in Barrick, we would have a big holding in, say, Eldorado, which is a medium-sized cap company, rather than Barrick, which is a big one, because we think Eldorado will find it easier to grow at a faster rate than Barrick because it's starting from a smaller base.
Okay, Ian, thank you very much for your thoughts this morning, especially a lot of people are interested in Bullion and those stocks that you've been talking about. Thanks for your time this morning.
What's the value in Canadian?
Okay, thank you.
Ian Williams, Chairman and CEO of Charteris Treasury Portfolio Managers.